We're going to get started on our next panels of the day. Hope you enjoyed the keynote presentations by Matt's VC and the Chainsmokers. So our next panel is examining the equity and fixed income market since the outbreak of the COVID-19 pandemic. Before I introduce the moderator, I just want to remind everybody that if you have any questions, please ask them as they arise. So, don't wait till the end. Please feel free to use that Q&A section to the right of your screen. But all right, let's get started. Our moderator today is David Pappalardo, who is the Senior Vice President, who is a Senior Vice President and the practice leader for the Advisor Solutions Group in Segal Marcos Advisors Boston office. He has over 20 years of experience in the investment industry. The Advisor Solutions Group is responsible for providing a full range of consulting services to broker-dealers, banks, insurance companies, registered investment advisors, multifamily offices, and other intermediaries that serve the high net worth marketplace. And here to tell a little bit more about himself and hand it off to the panelists to introduce themselves is Mr. Pappalardo. Take it away whenever you're ready.
Thanks so much, and good afternoon, everyone. Just a couple of notes on my background and what we do at Segal Marco as it relates to the advisory business. I'm based in Boston, and as mentioned, I run the intermediary practice. So our clients are RIAs, multifamily offices, insurance companies, banks, really anyone who's not a typical institutional client. And we provide due diligence services, asset allocation guidance, and really any type of outsourced research services that an advisory firm is looking for. So look forward to speaking with you today. Before we get started with our topical discussion, I wanted to give both of our panelists an opportunity to introduce themselves. So we'll start with Jib Dunham.
Great. Thank you, David. I hope everyone is safe and well in terms of the COVID crisis, and also everyone on the East Coast is safe and healthy after the storm yesterday. We lost some power lines in the New York area. As David said, my name is Jib Dunham. I'm the Chief Investment Officer for a firm called Bridgeway Wealth Partners. We are a multifamily office and RIA based in New York City with a national presence. We host a number of institutional accounts, individual accounts, high net worth, and family offices. We also have an insurance practice and an asset management business. And we're very grateful to be included in this conference.
Thanks, Jib. And so now I'll ask our other panelist, David Beach, to introduce himself.
Hi, hello, everyone. Good afternoon. Also in New York City. So my name is David Beach. I run a small firm called Crestmont Investments, where we work with family offices on direct investments and co-investments. I'm also an advisor to Gordian Group. Gordian Group is a specialist in restructuring and advisory work with a keen focus on family offices where investments have gone bad, and we have a need to figure out a way to restructure and save an equity investor's primary interests. So we're most especially focused on private investments, co-investments between family offices, and the equity and debt markets, as we're all seeing, is a very active place right now and a very tumultuous place. But thank you, David, and thank you, Gib. It's great to connect with you.
Thanks, both of you, for your introductions. And so we can get started with the discussion. And, obviously it's very timely. I think it's a pretty safe statement to say that none of us has seen anything like what we've experienced in the last 6 months, both from a societal standpoint and certainly from a market standpoint. It's keeping us all on our toes, and consequently our clients, I think, are always looking for guidance, especially these days, for how to navigate the markets. And so I think maybe an interesting starting point for context is to kind of think pre-COVID, what we were giving as typical advice, so to speak, to try to put it into context, and perhaps what we're providing to clients now. So maybe I'll ask Jib to talk about maybe what a typical asset allocation looked like for your clients, to the extent that there is such a thing, prior to COVID.
Sure. Thank you, David. Yeah, it seems like the world's really changed 180 degrees in the last 6 months. As I think back towards the end of 2019, we were recommending allocations of, the typical 60-40, life was easy. Back in the beginning of 2019, you were getting at least some yield. In early 19, the 10-year was like 2.6%. At the end of 2019, it was 1.8%. You look where it is now, it's really moved. I think, our thoughts on allocation have really changed. Given this crisis, it hit really quickly, it hit hard. Some sectors have rebounded. I think we're going to talk a little bit later about sort of more of a tactical and what we're thinking on the equity side, the fixed income side. But, at a high level, it was a much simpler world. Sort of the 60-40 worked. Now, well, it's just, so in that regime, pre-COVID, sort of that's where we were. And was a sprinkling of private equity or alternatives. But gosh, the world's changed. I mean, think back then, oil was, you probably, without thinking about it, had to have an allocation to oil. You had to have an allocation to real estate. Had to have an allocation to, investment grade fixed income. All those asset classes now are either sort of, have to rethink them, or they're not providing enough return expectation.
So thank you for that response. I think if I'm hearing you correctly, it's sounding like, at least as with respect to your clients, that you might actually be recommending something with slightly less diversity from an asset allocation standpoint, during the current situation than probably before COVID. Is that a fair statement?
Yeah, I mean, I think in time, when the market, so the analogy that I heard that I think is really appropriate is the market's an escalator up and an elevator down. So in other words, when it declines like it did in March, it's down 20 or 30% in a matter of 2 or 3 weeks. And it takes, in normal market times, it takes 2 to 3 years to get a 30% return. Avoiding the market noise and the market chop. So we've sort of taken a modified approach where we're being a little more tactical in terms of diversification. I think for me, it's less. Yes, obviously, I want to have a diversified portfolio, but I'm focusing more on the correlation than I am on necessarily diversification, because I think that owning 50 stocks is meaningless if they're all correlated. And we've seen a world right now. The markets are sort of, there's two sides of the two camps here. One part of the equity market has rebounded. That's gold and technology for the most part. And then there's still a whole subset of the market that's still, it's still down as much as 50 or 50%. Hotels, airlines, cruise lines, restaurants, things like that. So, we're focused more on sort of looking at the correlation of the stocks, much more so than we were early last year.
Understood. And, I can say, at least from the perspective of my firm and dealing with our clients, we've seen tremendous demand, obviously, given the dislocation in the markets, looking for what opportunities are out there, particularly in the alternative space. So there's been both tremendous work done by our firm and a lot of demand, I think, in the marketplace. Is that consistent with what both of you are seeing as well?
Yeah, and I would add that, a couple of the key changes we've seen from the investors we work with is, an acute interest in anything distressed, kind of once in a lifetime opportunities. Like, what do we do now that we wouldn't be able to do any other time? This is a pandemic is not something that we hope happens every year or every 20 years. So what kind of investments can be made now that are getting into the point when you may not see this again? And on the equity side, we're seeing a tremendous interest in, equity dollars being deployed in a manner that's very protective, to where an equity investment doesn't look that much different than some sort of a debt piece, because the investor wants to make sure they're not going to lose everything and they're coming in at a place of real stability.
And at least in your experience, is this coming from, if you think of it from a broad allocation standpoint, is this coming more from, say, within an alternative allocation where they're reallocating to distressed or opportunistic, or is this also being benefited from reallocating, kind of in this new normal, so to speak, or this opportunity to reallocate and put more money to work from a percentage basis into some of these types of opportunities?
I'll give a quick perspective and give, I would say that we're seeing investors take a really keen interest in what they're invested in, whether it's through a fund or through a direct investment. They want to know who's involved. ESG is a constant, impact is a constant theme. How are they investing and how can it help the world, be a better place? And then also, how can they take advantage of things going on right now? Gib, maybe you have a different.
Yeah, I think what we're seeing is that we're taking a hard look at dispersions, because for the first time in a long time, we're seeing really dramatic outperformance in some sectors and underperformance in other sectors. And so now is a great time. And if you're a growth investor or tech investor, obviously the markets have rallied considerably off of the March lows, and now the NASDAQ is at all-time highs. I think it hit a new all-time high today. But meanwhile, if you're a value investor, taking a hard look at, if you're a value investor, this is a paradise, because you're seeing, really almost once in a lifetime or once every decade type of bargains. If you like, this is a good time maybe to buy hotels or something like that. So it's really the dispersion is causing us to have these discussions with our clients about really where we think the opportunities are.
Sure, thanks for that. And I think you had mentioned at the beginning of our discussion, Jib, about talking about strategic versus tactical asset allocation, and I think it's always a hotly debated topic and a philosophy. And my 2 cents is, my firm has historically been strategically oriented as it relates to asset allocation advice, and I think that kind of speaks to the heritage of the firm as an institutional advisor. Obviously, on the advisory side, there's been more demand in pockets for tactical asset allocation, and be curious to get your perspective on what you're doing in this market and specifically what you're hearing from clients in that regard.
Sure. Well, listen, I think it's good to have a long-term strategic plan and to understand your goals, because I think that really helps inform your investing. So I'm 100% for strategic sort of outlook. I think where maybe we differ from some other firms in terms of our philosophy is that we like to add a sort of a tactical overlay where we look at both the sort of the fundamentals, but also the technicals of a stock or an ETF or a subsector, and sort of combine those two. I'm actually a big fan of relative value approach. I studied technical and got the CMT designation, so I think it's sort of the combination of those approaches that can really add a lot of value. Just when the market moves as dramatically and as quickly as it did, for us, having those tactical allocations can either add extra return on the upside or try to mitigate some downside or reduce risk when the market's going down in February, March, and April.
Sure, and I think related to that is obviously the market's rallied incredibly over the last several months, but when you dig into the details, it's extremely narrow. Saw something recently that if you backed out the FANG stocks from the S&P performance, it's significantly less attractive than it's done kind of looking at it in its totality. And so as it relates to overall asset allocation, whether it be strategic or tactical or some combination, I think factoring in the narrowness of the market is something that at least we see a lot. We get a lot of questions about where are the opportunities, and I think, David, as you mentioned, there's a lot of demand that we're seeing as well on the distress side. So I'm just wondering if you both could kind of comment on the narrowness and how that may change your perspective in the conversations, not only that you're having with clients, but just in the demand that you're seeing.
Yeah, I would say just, tactical asset allocation seems to be the theme of the day, whether it's driven by, a short-term concern. We work with some investors who have just really seen their real estate portfolios just flipped upside down overnight. Things that they probably would have never imagined would be at risk are all of a sudden illiquid or worse. So, partly just managing for that unknown short-term or intermediate-term outlook, in addition to the opportunities that are coming up that are short-term in nature and may correct themselves by next year, or we don't know when they may correct themselves.
Sure. And Gib, what's your perspective?
Yeah, look, I think to your point, you're 100% correct. It's 10 stocks that are driving the vast majority. It's the FANGs plus maybe NVIDIA and a couple others, Tesla. I think, gosh, I wish I could go back in time and put all my money in electric vehicles, because between Tesla and Nikola and we're now seeing a SPAC coming out, we're definitely seeing a bubble forming in the electrical vehicle market. But that aside, yeah, it's a small number of stocks that are moving the market. But I think we've seen this before, actually, over the last couple of years. Apple, as a contributor to the market performance, has been disproportionate. We saw this back in 98, 99, certainly. So it's not new. It's just a different set of names. It's just interesting that this time around, it's again technology. And maybe going back to the earlier question about pre-COVID, post-COVID, I think the world is different. The tech stocks were outperforming, or have been outperforming for about 5 years, maybe longer. If you do a relative value chart of the NASDAQ to the S&P, the NASDAQ's been outperforming for close to a decade by a fairly wide margin. So yeah, I think you've got to pay attention to these. You can't just buy the market. I think you really have to pay attention to sort of what's working, because this is definitely, as a momentum, as a factor, has been a huge outperformance.
I would add something too, and you mentioned the electric car potential bubble, and there's momentum that we've seen that could have long-term, massive, world-changing implications, like the move to electric vehicles and things. But yet the current valuations may be getting too high, and so we've seen an interest in lithium, for example, going to look at the core substance. Okay, well, what if it's a core theme that's going to last for a long time? What drives it? What are the elements behind it that maybe have not been explored or invested in yet? So lithium, for example, that powers the batteries. So anyway.
Yeah. Just to follow up, I totally agree. Whereas we thought technology would be, moving the world forward, it certainly has, and now, COVID has forced us to embrace technology even more. So I'm not surprised to see the NASDAQ at all-time highs, and some value indices still below their all-time lows. I think rightly so, because we're going to be on Zoom for a long time. I think even after we have a vaccine, people will probably be working from home 3 or 4 days a week, maybe going to the office 1 day a week. My firm is actually we were looking to switch offices in January, and we gave up our office. And when COVID hit, we're officeless, thankfully, because now we're not paying real estate. And we're just not even sure what that looks like, or even when we'll go back. We're probably thinking, Q4, but we'll probably have a much smaller office. But everything will go online. Everything will be, in the cloud. I think we'll have an office, and this is a huge paradigm shift, where you walk in with just your briefcase, you're literally without anything in your hands, and all your documents, your email, everything is just online, and you can remote in from anywhere. This is what we were talking about back in '99, but now, because of internet speeds and 5G and computing power, we finally achieved that goal. It's amazing to see.
Yeah, It really
Well,
is.
and especially if you take your experience and amplify it across countless organizations and employees, and just try to extrapolate that to see what the impact is going to continue to be as we go out into the future. Because I agree with you. I think it's we're not anywhere close to going back to full capacity in these major cities and office buildings. So it really has pretty mind-blowing implications, I think. But thank you both for your perspective. I think the topic that we're discussing is the implications on both equity and fixed income. And I want to talk about equities for a couple of more topics before we transition to fixed income. And so specifically for equities, we talked a little bit about strategic and tactical asset allocation and about the narrowness in the markets, which is pretty well established. But one of the things that's obviously been a long-term theme well before COVID is from a style standpoint. It was mentioned earlier in our discussion about the dispersion between growth and value. And just wondering from both of your perspectives, if you have an opinion on navigating that, which is, I think, frankly, a fairly challenging topic. I know some tactical allocators have been able to allocate away from value. More strategically oriented firms, it's much more difficult to maintain, a somewhat equal weighting. But just wondering both your perspective on it and kind of what you're hearing from clients as well.
I'll give a brief. So I was just laughing, thinking that everything right now is either massively overvalued or massively undervalued. And so from a value investor standpoint, it's, good Lord, do your homework. From a growth standpoint, it seems like a similar kind of, polarization where people are needing growth capital for legitimate, amazing, once in a lifetime opportunities, or they're really heavily distressed and it's not growth capital. They're about to go under because the world has changed. So I, come back to the answer to the growth or value equation outside of the investor's perspective. A lot of homework needs to be done with what's going on and how the world has changed.
Yeah. I mean, look, this is probably the second most important question in finance today. What do you do with your equities? I mean, certainly the growth names have performed unbelievably. They continue to be strong. At some point, they get too expensive. They're great companies, but at some point, the valuation gets too high. I mean, it wasn't literally 18 months ago, we wondered if a company would ever get to a $1 trillion market cap. And now, we blew through that. 4 or 5 companies have blown through that. And now Apple's like 5% away from being a $2 trillion company. And that's all happened in the last 18 months. It's amazing. So I mean, as I look at the equity world, obviously the FANGs have really performed. As we talked about, the electric vehicle stocks have really outperformed, and gold is really the third subgroup that's really outperformed. If you look at the losers, which are potential, the real value players, it's the travel, casinos, oil, cruise lines, airlines, hotels. I'm actually we've been allocating recently to restaurants. I really like not the Wendy's and the McDonald's, but like the mid tiers, like the Cheesecake Factory, Brinkers, because I think people want to get out and they want to do something. They're not going to get on a plane, but they'll, go to a restaurant. So I think that's the first, I think the mid-tier restaurant will be up 50 to 100% in the next year or two. I think that's the first value sector to sort of rebound. I have a bet on, I think, Boeing. I think they'll get the 737 back together pretty soon myself. And I think because of their defense business, they're too important to fail. So I think that's a great value play. But some of these things, like casinos and airlines, will take a lot longer to come back because the economic model isn't nearly as robust. So that's sort of my advice of the day.
Great. Well, thank you. And I think kind of related to, talking about style, another popular topic, especially within U.S. equities, is the cap spectrum. Obviously, as we've talked about, looking at the FANG stocks, the markets have been driven by the mega caps, really to the detriment of, the mid and smaller caps by comparison. Just wondering your perspective on where there might be opportunities, both in the kind of the traditional and the alternative side from a cap spectrum point of view.
Yep.
So like you're talking alternatives. You're talking about small caps.
I'm talking about both. I mean, certainly,
Okay.
I know, on the traditional side, obviously, there's been a huge disconnect from a performance standpoint between the mega caps and small cap, but also asking kind of more broadly about where there's opportunity potentially in the below mega caps on both traditional and non-traditional.
I'm happy to speak to the non-traditional. I mean, the opportunities. The smaller cap space, I think, has been a place where we've mainly worked with family offices. Large private investors have looked to, leverage their expertise where they made their money, their kind of familiarity with whether it's in the garment industry or the technology industry or wherever they happen to have generated their wealth, and look at how they can leverage that. And so we're seeing opportunities, but I would say it comes back down to those industries that we can't live without, like you mentioning Boeing. Social media clearly is here to stay. Technology is invading everything, but we're seeing some amazing innovation. Companies that are looking at, how to make healthcare administration more effective and more efficient. So coming back, I think small caps the place to be. I think the large caps, it's the value's either there or they're decimated for a reason. But in the small cap space, we're seeing a lot of great opportunities to come into companies that we truly can't live without what they're disrupting or what they can offer. And they don't have they're talking to an audience that's scared to death to invest. And so those investors can get great pricing and great protections that otherwise they may not have gotten.
Yeah. Yeah, I know. I agree with what David just said. If you, it seems like all the interest in the market is going towards the FANGs and the top 10 tech stocks, and there's no love for the small cap players, which presents an opportunity at some point when tech rolls over. I think you're going to see a massive reorientation and reallocation towards small caps, towards industrials, towards these value names. Even towards the emerging market. If you look at a relative value chart of the emerging markets, the EEM to the SPY, over the last 8 years, it's gone in a straight line down. That ratio has gone out from 39 to 12. I mean, this shows how unbelievably undervalued international emerging market stocks are too. I mean, this is like 6-7 standard deviation stuff, like stuff that isn't supposed to happen in our lifetime.
Yeah, and that's the real key, is look for those events and make sure it's not for good reason.
Yeah. Right.
Absolutely. Well, thank you both for your perspective. And in the time we have remaining, I want to transition now to talk about fixed income, obviously a hotly debated issue, and just wondering, how your guidance has changed within fixed income and talking to clients, kind of what you're seeing, and just kind of your overall perspective would be a good starting point.
Sure, I take a stab at that. From my point of view, this is the most important question in finance investing today. What to do with fixed income? I mean, there's no yield. The 10 years at 52 basis points. There's no yield out there. The high investment grade is not providing that return. So the question is, what do you do? It's like that, nightmare you have about you go into a college exam. There's you look at the question. There's no right answer. There's really not much you can do. My view, I sort of on the liquid side, I think I like high yield munis right now. If you follow those, they've been decimated, and you can get a triple tax-free bond yielding 7 or 8%. I'm not talking geos, I'm talking revenue bonds that are backed by a specific project or real estate. So you're basically 100% collateralized. mean, this is money, in my opinion, money good, with a very attractive 8% tax-free yield. I'm actually seeing nonprofit endowments asking me about these. And normally you'd never see a nonprofit organization invest in a muni bond because they're already tax exempt. But so I think this is, to me, this is probably the single best place to invest in fixed income. I also think that now is the time where you look for alternative yield from alternatives, whether it be private credit funds, whether it be funds that do mezzanine loans, and plus they get warrant coverage. Venture debt funds. I'm actually a big fan of that asset class. I think we're seeing, in this sort of quote unquote shadow bank theme has developed over the last 4 to 6 years. A lot more money is migrating to private credit, but they're getting 10% yield, and maybe you have a 1 to 2 year lockup or a 120-day gate. But if you can put that money in there, it's a way better outcome, I think, because listen, at some point yields are going to back up, and people who are holding 10, 20, 30-year bonds are going to see, a 10% decline in their fixed income portfolio, which is supposed to be the sort of bedrock of the portfolio. So it's just that day. It's probably not in this year or next year, but at some point you're going to see those long-term bonds really get hit.
Real quickly, the alternative side, we're just seeing, equity that has to carry a yield in order to attract investors, and then we're seeing tremendous opportunity in buying distressed debt from those companies we can't live without, or industries we can't live without.
Great, thank you. And I think at least from my perspective, one of the number one questions from advisory clients is, how to generate yield in this environment, which obviously is as you both pointed out, a difficult nut to crack. And it's some combination with some advisors of looking at preferred securities, looking at opportunistic credit, distressed, high yield. It's really quite a combination, really depending on their own risk tolerance and taste for those types of investments. But just curious, if you have a client, if someone's looking specifically for yield, if you could talk a little bit about maybe some of the options that you're either seeing or recommending. I know you touched on a couple of them already, but I think what might be useful is to talk about it from the perspective of, there's obviously a continuum. If someone has a high risk tolerance, they can obviously go into things that someone that's a little bit more conservative it wouldn't be appropriate. So maybe if you could comment a little bit on that, maybe Jib, if we start with you.
Yeah, again, it's a really tough question, and we struggle with it every day. I like those high yield munis. I think that's a good place. As you said, David, preferreds is probably a good place to invest, or even adding a component to your equity portfolio that's the higher dividend stocks. That you're seeing some value stocks with 4 or 5% dividend yields. I've never been an expert in sort of the mortgage REITs, so I don't know one way or the other. My hunch is that some of the publicly traded REITs have been so hammered that you're seeing attractive yields and probably a lot of downside protection because the prices are already low. But I don't have a great answer to the question.
As you said, it is I think really one of the burning questions that clients and advisors are grappling with, just given that there really is almost nowhere to turn in some respects. I think one of the things I want to end on is, we're talked about very broadly equity and fixed income, and we've touched on some alternatives. Maybe to the extent that we haven't already talked about it, from either of your perspectives, is there an asset class or an opportunity as you look forward that advisors and clients you think should be aware of that you think is attractive, given the market dynamics? So I'll open it up to either of you to jump in on that.
I'll kick it off. So, one thing I've been impressed by is, healthcare, life sciences, some of the areas that would have been considered growth pre-COVID, and maybe had some risk, that was maybe worthy of outsized returns associated with them. We're seeing those kind of deals being priced really attractively, and we're seeing management go through amazing extra steps to ensure and mitigate that risk. So I think investments in healthcare and life sciences, is a theme that it's going to live past this pandemic. It's an area that's just changing, affecting all of us, and acutely, right now. And it's an area where this, earlier stage, it's hard. Small caps are going to be, they're going to have a hard time getting capital. So it's a good place to probably, make your own deal. The other side I would say is getting as close to the asset as possible. Like we talked about electric vehicles, we can go to lithium, go to the battery manufacturers, go as close to the source as you can for industries we can't live without.
Yeah. I would hazard a guess and say we're probably closer to, market highs than market lows. So, in that context, we're doing some work on some low net hedge funds, some private credit funds, some direct loans. There's a really interesting real estate fund that has sort of a very structured approach that we like. There's some really idiosyncratic funds out there that have very low correlation. So, life settlements, litigation finance, those things will put up, probably mid-teens returns in any type of market. So, if you can put together a basket of those for clients, I think that's a smart bet. Because I think if you can get a low teens return for the next 3 years, you'll probably beat the market without taking undue risk. Now, it obviously requires a little bit of illiquidity. So, but if you can stomach that, then I think that makes a lot of sense.
Sure, and I would just add that not so much even from a perspective of an asset class or a sub-asset class, but certainly what we're seeing is given the opportunistic nature of a lot of investments out there, I would say from all the managers that we talk to, it's a much more robust environment for managers being flexible, being willing to take lower minimums that are much more friendly to the advisory channel, much more attractive fee schedules. The lockups are not nearly as long. Just a lot more managers that are willing to be creative and flexible in how they work within the advisory channel. And that's obviously not a new trend, but I would say that definitely have seen an acceleration in the last 6 months with COVID, where managers are, I think, obviously not traveling and are focused more on how to keep assets, how to raise assets, and be creative in doing that. So I think that's a win-win for not only the end client, but obviously anyone advising them.
Yeah.
Correct. Right. Yep. 100%.
So with that, I think we're kind of pushing up against the end of our scheduled time. So unless there were any questions that needed to be answered, I think we've arrived at the end of our time. So I just want to thank the panelists for their time and thank the audience for your time and attention. Hope you found this very useful, and stay safe and healthy.
Thank you, David, for moderating, and thank you to Opal for hosting.
Thank you.
Guys, thank you so much for being able to join us today and participate on this panel. David, and Jeb, thank you so much. Again, guys, if you have